How's everyone doing tonight? Welcome to the Strategy Room. You are here with the banker next door on this Friday night, December 12th, 2025. Normally, for most viewers, they know we do this on Saturday night, but tonight it's kind of a special thing this weekend, so I had to move it to Friday night here at 8 o'clock. So I hope everyone has had a great week out there. So far, we've got a lot to talk about tonight. I do want to give one quick disclaimer. I am feeling a little under the weather, so perhaps not coming with my normal energy tonight. My throat is a little scratchy, so I'm going to try to get through this as best I can. But if for some reason my throat is not willing to go the full 2 hours tonight, I might cut a little early. But like I said, we're going to try to get through this together as best we can. So what do I have tonight? We're going to be talking a lot about the Fed's interest rate decision. Obviously, they decided to cut rates by another 25 basis points this week. But what else are they going to do? Are they restarting quantitative easing? That's a big question. Are they, is what they're, they want to go back in, basically start buying some bonds and stuff again. So we're going to talk a little bit about that tonight. What's their overall strategy there? We're going to talk about the Fed renewed a bunch of their governors for next year. We're also that Trump is also ready to start his final interviews for who the next Fed chair is going to be. We're going to talk about that a little bit. I also got, Janney Montgomery Scott, a small investment bank here in Pennsylvania, decided to sell their investment banking business to focus more on wealth management. We'll talk about that a little bit later. I've also got a number of articles here, just like we're going to talk a little bit about economic indicators. We're going to talk about, Scott Bessent wants to completely overhaul a regulatory body. So we got a lot of stuff that we're going to get in here tonight. A lot of things we're going to dig into. But I want to kick it off as I normally do every week, and we're going to look at the U.S. debt clock. So U.S. debt still hovering in at a little over $38 trillion. The U.S. federal budget deficit still hovering in at $1.7 trillion. The tariff revenues now up to $370 billion with $3,247 per taxpayer. The debt to GDP is still hovering in at 121%. Interest on the national debt is still hovering around $1 trillion, $967 billion. Credit card debt still hovering in at $1.3 trillion. So again, not a whole lot of change between this week and last week. Nothing really new there. But like I said, always like to bring that in because we do work this back in periodically throughout our conversations of the night to see what's going on, to make certain points. Now, I want to show everybody, because I want to talk about this for a minute. And hang on, let me make this a little bit bigger here so everybody can see this. Okay. All right, so let's focus in on the 10-year Treasury note here for a second, shall we? All right, so the 10-year Treasury was up today. It's currently hovering in at 4.184%, as everybody can see here on the left-hand side. So one of the interesting things we're going to talk about is, why is the Federal Reserve cutting rates, and yet we're seeing the 10-year Treasury rate go up? And we're going to come back to that. Keep that in mind. We're going to come back to that in just a second. But so what have I said? What have I been saying over the last few months? The ideal range that we're looking here is 4%. We want to see the 10-year Treasury at 4% and hopefully a little lower, hopefully down into the threes, 3.8, 3.9. That's really where we want the 10-year Treasury to be at, because as I've said many times before, your residential mortgage rates. So in other words, if you want your 30-year mortgage rate to come down, we need that 10-year Treasury yield to come down a little bit. Not a tremendous amount, but we need it to come down a little bit. And right now, it's not going in our favor. And we've seen this phenomenon that as the Fed is reducing rates now, and keep in mind, when the Fed cuts rates, what they are cutting is called the federal funds rate. That is directly controlled by the Fed. The Fed funds rate, not to be confused with the 10-year Treasury. And this is one of the things I'm hoping to try to clear up here, when a lot of people are sitting there scratching their heads going, well, wait a minute, I don't understand. Why is it that the Fed cut rates, but then the 10-year Treasury rate goes up? So we're seeing the 10-year Treasury rate go up. And you can see here on the right-hand side how basically this has trended over the last 4 or 5 days, the last week here, and we're still within the broad range. I mean, 4.1 4.40, and then today we're at, like 4.184. So again, still staying within a certain range. We haven't jumped out of that. And what I would say is I would expect this to start to creep back down a little bit here over the next few weeks. I think we're going to get a little bit of pause in the Federal Reserve rate reductions. I really don't expect anything to happen in January. And I do have to say, I was wrong. I have to eat a little bit of crow here. I was wrong. I did not think that Jeremy Powell was going to give us this quarter point rate cut this week. I have to admit, I said that last week. I didn't think he was going to give it to us. I thought he was going to put a lump of coal in our Christmas stocking, but he decided to relent. He decided not to do that. He did cut the rate, the quarter point, which, hey, we all thank him for. That's great. Wish he would have done a little bit more, which he would have been a little bit more aggressive in the rate cuts this year. But that's okay. I'll take, again, I'll take it for right now. I will take it for right now. So, but let's bump back for just a second here, because I just want to show everybody. So, okay, if we pop back out here for a second, I just want to show everybody where the 2-year is at right now. So the 2-year is at 3.533%. The 10-year is trading up at 4.18%. So we've got about a 60 basis point spread between the 10-year and the 2-year, which means a steepening yield curve, which means that's pretty good. That's what we want to see. So that's not bad. So that's all right. So we'll take that for right now. So now here's the question of what I just said. If I could share everybody this article from Investopedia. So let's take a look at this. So if the Fed is cutting interest rates, why are 10-year Treasury yields rising? How does it affect you? It's a wonderful question. We just asked that. So the 10-year Treasury yield rose to a 3-month high on Wednesday morning, even as investors awaited an interest rate cut from the Federal Reserve. The disconnect between official rates and market rates is likely being driven by a variety of factors, including an uncertain economic outlook, rising government debt, and threats to the Federal Reserve's political independence. Now, I would say it is because of number 2, rising government debt, as opposed to, I don't think your average Joe on the street really cares about the Federal Reserve's political independence. I really don't think they give two whats. The uncertain economic outlook, okay, maybe, but I think this rising government debt, I think that is the biggest issue, because the rising government debt has a giant effect on what? Treasury markets and bond markets. In other words, the government has to issue that government debt, and they have to issue the treasuries. We have to have treasury auctions to issue that debt, and then they have to sell said debt, and then that goes into the bond market. And and the rates there, again, what we were just looking at, all these rates here on the 1-month bill, 3-month, 6-month, 1 year, 2 year, 3 year, 5 year, 7 year, 10 year, 30 year. These are all notes that get sold. They are bills and notes that get sold into treasury auctions. And this is the big thing. And what are the rates? What are the rates being offered? What are the spreads? The more debt you have, when, again, going back here, if you have $38 trillion in national debt, and you have to fund a $1.3 trillion federal deficit, meaning you're to the negative, you're not in the positive, you're to the negative $1.7 trillion. When you have to fund this, you have to get into how are you initially funding it? Well, if you're going to fund it through short-term bills, which is what has been happening, then you have to roll over those bills. And usually you're rolling those bills over at much higher rates. Now, I will give credit where credit is due. Scott Bessent has done an absolutely beautiful job rolling over a lot of this treasury debt this year. We had like $9 trillion in treasury debt that had to be rolled over this year. And he did a masterful job of rolling this debt over and keeping everything going without seeing any major spikes in the yield curve here. Now, we are seeing a spike on the high end on the 30-year bond. That's jumped up to 4.8%. Okay. But the rest of this stuff has kind of remained exactly where we wanted it to be. So I would argue that it's the government debt here that is the biggest thing. But let's hold off for a second. Let's see what does the rest of this say. So official interest rates are declining, but not the rates that could matter the most to everyday Americans. Treasury yields ticked up to a 3-month high on Wednesday morning, despite near certainty on Wall Street that the Federal Reserve was hours away from cutting rates, which it did. The 10-year Treasury yield, which influences interest rates on a variety of consumer loans, including mortgages, rose Wednesday morning to 4.21%, its highest level since early September. Meanwhile, traders put the probability of a quarter percentage point cut today at 90%. Conventional wisdom says the Treasury yields decline as investors grow more confident the Fed is about to cut its policy rate. But that's not what's happening in recent weeks. The probability of a rate cut increased 7 percentage points in the past 2 weeks, while the 10-year Treasury yield has risen about 20 basis points. The Fed doesn't directly set the interest rates paid by consumers and businesses. Like I said, the federal funds rate, versus the 10-year Treasury. Instead, it sets the rate it pays banks for the money they hold in reserve accounts at the Fed, which effectively sets a floor on interest rates. From there, market forces likely supply and demand take over, which can drive a disconnect between monetary policy and interest rates out in the wild. Kind of an interesting way of saying that. Wall Street's concerns about the growing U.S. national debt could be helping to nudge yields higher. Yes, absolutely. The tax cuts included in the One Big Beautiful Bill Act signed into law in July are expected to add more than $3 trillion to the national debt over the next decade. Actually, no, they're not. That is completely wrong. And the CBO actually came out and looked at it and said, no, they actually, and I reported on that a few months back about how the CBO was actually about how this was incorrect. And the CBO actually put out the correct data, basically saying that, no, it will add a little bit to the national debt, but it's not going to add anywhere near $3 trillion. And the other side of it too, is that they're not when that number originally came out, they did not factor in any tariff revenue. They factored in zero tariff revenue. We've already seen we've had $369 billion. How much tariff revenue we had? $370 billion in tariff revenue year to date. And they did not include $1 in tariff revenue when they originally put that number out. So I'm calling a lie on that one. They lied. Go get them. Investors may be demanding more compensation for buying U.S. government debt because they're concerned about the government's ability to pay up in the future. Yeah, now that is true. Policy uncertainty and geopolitical risk could be weighing on demand for U.S. Treasuries from international investors, historically major buyers of U.S. debt. President Trump's unpredictable tariff policy sparked a Treasury and U.S. dollar sell-off earlier this year. Yeah, nobody cares. That's old news. Though recent Treasury market data suggests foreign appetite for U.S. debt, while not as robust as it once was, remained healthy through September. Yes, it is. Rising yields could reflect uncertainty about the trajectory of inflation and subsequently monetary policy. Inflation has remained elevated this year, likely boosted by President Trump's tariff policy. No, again, another lie. No, it's not. No, it has not been at all. Investors are unsure if tariffs will drive sustained price increases that the Fed would need to respond to with tighter policy, or whether policy can loosen as inflation returns to its downward trajectory. Okay. But the point being here, I love, Investopedia, they do a lot of things good, and they really do put out a lot of BS too, which is very frustrating. But I get back to my point here of what's happening here. So the 10-year U.S. Treasury, if we go back for just a second here, 10-year T-note right here. The 10-year T-note drives everything for us in our consumer lives. It drives the 30-year mortgage. It drives credit card rates. It drives auto rates. It drives student loan rates. All of that stuff is driven here by the 10-year Treasury. The 10-year Treasury, while it can be aided by the Federal Reserve, in other words, the Federal Reserve decreasing interest rates on the federal funds rate can have an indirect impact on this. It can affect markets in different ways, depending on how people are viewing monetary and fiscal policy, geopolitics, political, uncertainty, how people are viewing all those factors, how Wall Street feels about all those factors can determine kind of what's going on with the rates. And so a lot of those things are playing in. I still believe that the government debt and the debt crisis, if you will, is what is, driving these rates, nudging these rates up a little bit, even while the Federal Reserve is cutting rates. So, I hope that helped to explain. I hope that, I hope that little explanation there helps to, give people a little bit more understanding as to, you're looking at it, you're going, wait, I don't understand the Fed cut rates. Why did the 30-year mortgage rate go up? I thought it should be coming down. So again, hopefully this helps to explain this a little bit more in depth so you have a little bit understanding as to why certain things are going in certain directions. So um, okay, let's take a look at a couple things real quick. Now, I'm not going to go super in depth in this week. I went in depth with this a lot last week, and that is on the repo market, the overnight reverse repurchase agreements. I made a whole conversation here showing the correlation between the Fed's balance sheet and the repo market, and how basically the Fed had drained all the liquidity out of the repo market by reducing their balance sheet. I went into all that last week. I just wanted to show everybody the chart again, just to show we're now down to $3.2 billion in the repo market. Not a good thing. We are seeing these spike ups in the repo market, but it has been a quiet couple of weeks. The last big spike up, this 13.5 billion, we saw this on Monday, December 1st. Since then, it's been pretty quiet over the last couple of weeks. Will things remain quiet through the last couple of weeks of the year? Most likely, probably will. Maybe we probably don't see another spike here until January, till after the new year. Because again, Wall Street has a tendency to get a little bit more quiet here by the end of the year. But I just wanted to show everybody this. So this is the chart on the Fed's balance sheet. Now, if we go over and look at just the last year, we see that we've gone from 6.8 trillion and they've taken it all the way down to $6.5 trillion. So we've come down about 300 billion here over the last year. But again, just looking at the chart, where's the chart going? Chart's going way down. And then if I go back to the repo chart, again, if we look at the 1 year, we could see a couple spike ups, but overall that has really come down. So you can see that correlation there between the two charts. So just wanted to point that out again. So now we'll get into our conversation here as a whole, just on the Federal Reserve's announcement. So divided Fed, and we'll talk about divided in just a second. So divided Fed approves third rate cut this year, sees slower pace ahead. So the Federal Reserve was split over where its priorities should lie, cut its key interest rate on Wednesday in a 9-3 vote, but signaled a tougher road ahead for further reductions. The FOMC dot plot indicated just one more reduction in 2026 and another in 2027, amid considerable disagreement from members about where rates should head. In addition to the rate decision, the Fed also announced it will resume buying Treasury securities. The central bank will start by buying 40 billion in Treasury bills beginning Friday. So I ask the question, is that quantitative easing? Did the Fed just turn the spigot back on? After its quantitative tightening by reducing the balance sheet for the last couple of years, have they now turned it back around, and are they now going to start doing quantitative easing, turning the printing press back on, and basically now they're going to start buying 40 billion in treasuries every month? And they're going to start increasing their balance sheet again. And I believe that they are doing this because, again, if we go back to the repo market chart here, there's nothing in the repo market. They got to start putting some money back into this repo market here. So I do believe that this is the biggest driver for why they're doing this. Now, here is the official FOMC statement. Before we get there, I just want to get into one thing. So, I'm going to read you guys another update before we get into this right here. So as expected, the FOMC lowered the federal funds target range by 225 basis points from 3.5% to 3.75%. The Fed will begin 40 billion of T-bill purchases on December 12th, which was today, to maintain an ample supply of reserves. A tweak in the statement referring to the extent and timing of additional adjustments suggests that officials are likely to pause their rate cuts in January. Yes, I would say so. So we'll see all. Just a couple of keynotes. The Fed says inflation has eased but remains somewhat elevated. Powell says consumer spending appears to have remained solid and business fixed investment has continued to expand, but housing remains weak. And then the consensus 2026 growth forecast, the median estimate is now 2.3% up from 1.8% in September. So overall, not bad comments there. But now let's get into the actual press release. Let's see here. So let's read through this for a second, shall we? Available indicators. You know what? Let me make this a little bit bigger here so everybody can see there. So hopefully that's a little bit better so everybody can follow along at home, as we always like to do. Available indicators suggest that the economic activity has been expanding at a moderate pace. Job gains have slowed this year, and the unemployment rate has edged up through September. More recent indicators are consistent with these developments. Inflation has moved up since early in the year and remains somewhat elevated. The committee seeks to achieve a maximum employment and inflation at the rate of 2% over the longer run. Uncertainty about the economic outlook remains elevated. The committee is attentive to the risks to both sides of its dual mandate and judges the downside risks to employment rose in recent months. In support of its goals and in light of the shift in the balance of risks, the committee decided to lower the target range of the federal funds rate by 1/4 percentage point to 3.5 to 3.75%. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee is strongly committed to supporting maximum employment and returning inflation to its 2% objective. So in assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The committee's assessments will take into account a wide range of information, including readings on labor market conditions, inflation pressures and inflation expectations, and financial and international developments. The committee judges that reserve balances have declined to ample levels and will initiate purchases of short-term Treasury securities as needed to maintain an ample supply of reserves on an ongoing basis. Let me read that last sentence again. This last sentence is critical to what I was just talking about. The committee judges that reserve balances, it's talking about repo. It's talking about, let's go back, let's look at our repo chart for a second. It's talking about this. It's talking about its reverse repo. So it's saying the reverse balances have declined to ample levels and will initiate purchases of shorter term Treasury securities as needed to maintain an ample supply of reserves on an ongoing basis. So in other words, what they're telling you there in English is that, hey man, we drained way too much liquidity out of the repo market, and now we really need to put some liquidity back in, because we are starting to see these crazy spike ups every week, every couple weeks, even every couple days. We're beginning to see these massive spike ups here, these massive blips. That's not good. That's not good. We don't like to see that. So we're going to start pumping some liquidity back into the market. So that last sentence was very important. Now, voting for the monetary policy actions were Jeremy Powell, John Williams, Michael Barr, Michelle Mickey Bowman, Susan Collins, Lisa Cook, Philip Jefferson, Alberto Masalem, and Christopher Waller. Voting against this action, we have three individuals: Stephen Mirren, who preferred to lower the target range for the federal funds rate by a 0.5 percentage point at this meeting, which I agree with him, and Austin Goolsbee and Jeffrey Schmidt, who preferred no change to the target range for the federal funds rate at this meeting. So what we'll talk about here in just a second. So you had 3 dissenting votes in this meeting, which is big. I have talked about this for over a year. I did an interview with former Federal Reserve Chairman Thomas Honig, and I would tell everybody to go watch that interview if you haven't watched it, where we talk about, we get into the whole dissenting vote issue and how for a long period of time here, about 15 years, you haven't really seen any dissenting votes. It's been almost a uniform thing, because the Federal Reserve chairmen especially, they do not like dissenting votes. They do not like that. They want to show uniformity amongst the members. I actually think dissenting votes are a really good thing. I think it actually shows healthy. It shows you that there is healthy and robust discussion going on over there at the Fed. I don't like when we see unanimous decisions all the time. That just leads me to say that, okay, everybody's either terrified of saying no, or you've got some major groupthink going on over there. If everybody just, everybody's in total agreement for, for, I don't know, a decade and a half. So you had three dissenters. One, Stephen Mirren, basically saying that they should have lowered the rates more, and then the other two basically saying that they shouldn't have lowered the rates at all. They should have just stayed pat. So again, very interesting. Again, you've got an interesting dynamic, and so you had, of the 12 voters, again, you had 9 saying for, 3 against, 3 dissenting voters, but in terms of the conversation, you have the Fed completely split, like 6 over here and 6 over here. Basically half of them saying we need to lower rates to help the labor market, and the other half saying, no, we either need to stand pat or maybe even raise the rates to fight inflation. So very interesting conversation going on over there at the Fed right now. So that's the Fed statement. Now let's get in, again, right in here. We'll go just a good lead in right here. So the Fed is the most divided it's been in more than 6 years. So 3 members of the Federal Open Markets Committee dissented on Wednesday, 2 for no cuts and 1 for a bigger cut. The last time there were 3 dissents was in September of 2019. So there were 3 dissenters from the Federal Reserve's decision to lower the federal funds rate by a 1/4 percentage point on Wednesday, making it the most divisive the central bank has been in more than 6 years, but I would say probably more so since 2010. Chicago Fed President Austin Goolsbee joined Kansas City Fed President Jeffrey Schmid in voting for no decrease. The newest member, Federal Reserve Governor Stephen Mirren, again called for a half-point cut. It is the 3rd dissent in a row for Mirren, who called for a half-point rate cut in both the October and September meetings. Schmidt also called for no decrease in October. The last time there were 3 dissents during a Fed meeting was in September of 2019. In addition, there were 4 other so-called soft dissents by non-voting meeting participants. The policymakers submitted a forecast for interest rates to have ended the year at the previous level of 3.75% to 4%. Hard dissents from voting members, as well as the soft dissents seen in the dot plot, highlight the Fed's hawkish block and the return of extent and timing language to the statement regarding future policy decisions was likely done to appease them, said Kay Haig, global co-head of fixed income and liquidity solutions at Goldman Sachs Asset Management. While this leaves the door open to future cuts, labor market weakness will have to clear a high bar, he added. However, Christopher Rupke, chief economist at FWD Bonds, said that the dissents against the rate cuts may not necessarily offer a window into next year's moves. The dissents ruled against a faster pace of rate cuts today, but the winds of change are in the air, he said. A new Fed chair in 2026 and perhaps many more new Fed officials means more interest rate cuts are coming next year, as rate cuts are big on the Trump 2.0 economic agenda, even if not listed explicitly. If for nothing else but to weigh against the slowing economy due to the import tariffs uncertainty. So, yes, I think he brings a very clear point here. Now, we're going to get, as we get a little bit deeper into this, I'm going to share something with you guys. So, and I'll just share this now while we're kind of at this point. So the Federal Reserve reappointed all Fed presidents and vice presidents effective March 1st, 2026, after reviews of their performance. And what a stellar performance it is. You've got, let's see, how good are they doing? Oh, they've lost over $300 billion the last couple of years. They've got a potential $1 trillion unrealized loss in their bond portfolios. They've managed to mess up the labor market. They were too late on interest rate reductions. They've led to increased inflation by pumping $9 trillion into the economy over the last 15 years. So, yeah, they're doing a bang-up job. I could totally see why all of these Fed members would get unanimously reelected, because they are knocking it out of the park right now. How many of you would keep your job after losing over $300 billion? I'm just curious. Just a question. Ralph Bostic is retiring as president of the Atlanta Fed at the end of his current term, and Shonda Clay has been previously approved as first vice president of the Chicago Fed starting March 1st, 2026, following the retirement of Ellen Bromagin from the role. So I just wanted to point that out. The Federal Reserve reappointed all Fed presidents and vice presidents effective March 1st, 2026 for continuing to doing the bang up job that they're doing. Wonderful. Okay, let's keep rolling. So now the Fed still forecasts just one rate cut for next year. So we're going to take a look here at what's called the dot plot. So this is the FOMC, the magical FOMC dot plot. So, and this is their dot plot for 2026. So, what does this tell us as far as future rate cuts? Well, we can see here, they lowered it down to this range of 3.5 to 3.75. So you can see a lot of people are still kind of in this range, and not really a whole lot there. Not really as far as like, again, what are they seeing as far as rate cuts? Not really too much happening there in that realm. The Fed's 2026 rate outlook was the most crucial data point traders were focused on as the central bank has become increasingly divided. Again, we talked about the two top no. The 2027 Fed projected the terminal rate hitting 3.1%, indicating further rate cuts. The rate is expected to remain unchanged in 2028, according to the dot plot. Yes. So, well, like I said, we'll see how this plays out. I think the comment here in this last article toward the end about, hey, the dissents ruled against a faster pace of rate cuts today, but the winds of change are in the air. A new Fed chair and perhaps more new Fed officials means more interest rates cuts are coming next year. So, yes, I think there's a lot of truth to that. So we could see a lot of changes in this dot plot coming up in the not too distant future. So we'll continue to keep an eye on this. But like I said, for right now, they're just looking at one more rate cut, just another 25 basis point rate cut for next year. So what are our big five takeaways from Wednesday's decision? So let's look at these real quick. So number one, the hawkish cut is real, kind of. Wall Street had been anticipating the Fed would deliver a strong dose of caution along with the cut, with a warning that the bar was high for additional easings. Markets, though, didn't seem to mind. Stocks posted solid gains on the day while Treasury yields fell. Number two, while a 9-3 vote might suggest broad support for the move, the Federal Open Markets Committee is different. 3 dissents is a lot, the most, in fact, since September of 2019. And one of the no votes came from an unexpected source. Like I said, we already covered that. Number three, the dots held. In short, the dot plot of individual official rate views were little changed for the coming years, with the median indicating just one cut in 2026 and another in 2027 before the Fed funds rate settles around a neutral 3%. Markets largely took the committee at its word, though future pricing late in the day pointed to a non-negligible 38% chance of 2 cuts next year. Number four, bond buying is back. Well, not really bonds, but bills, which the Fed will start buying again come Friday. With overnight funding markets feeling pressure, the central bank said it will buy $40 billion of short-term bills as part of the monthly program aimed at stabilizing markets and keeping the Fed funds rate within its quarter-point range. Buying levels will change, but some market participants viewed the announcement as a stealth easing, as is positive for risk assets. And then number five, Chair Jeremy Powell was mostly upbeat about growth, and so was the committee. We have an extraordinary economy, said Powell, who has just 3 meetings left as chair. FOMC officials raised their view as well, boosting the outlook for 2026 gross domestic product growth by 0.5 percentage point to 2.3%. So again, these are the 5 points here, like we were saying. So the hawkish cut is real. Again, may not see any cuts here for the next couple of months, January, February, March. We'll have to see what happens thereafter. But the 9-3 vote, the dissent is becoming a little bit more lively here. The dot plot held at basically just looking to cut one time in 2026. I think there will be more cuts than that as the year goes on. Jeremy Powell gets replaced. The bond buying is back. Now, remember here, well, not really bonds, but bills. So let's go back here for a second. So again, if I point this out to everybody, like we were just talking about a little earlier. All right, I made that a little bit too big there. Hold on a second. All right, the bills are these on the left-hand side here. The short-term the 1-year bill, the 6-month, the 3-month, the 1-month bill. These are the bills that they're talking about. This is what the Fed is going to start buying. They're going to start buying the short-term bills, and these rates may start to nudge up a little bit, depending on, again, they're going to buy $40 billion worth, which isn't like a huge amount. But that could, that could cause these rates to start nudging up a little bit, which again, don't necessarily want to see that. That's not necessarily what we're looking for. We're looking for hopefully these short-term bills to come down a little bit. But that will be the net effect of what they're doing. Like I said, and again, just to reiterate, they have to pump money back. It got to get more money back into this repo market because they basically drained everything out of it, as I've been saying. So, okay, all right. So those are the 5 takeaways. Now, what did Trump have to say to this? Well, the Trump says that the Fed could have at least doubled the latest interest rate cut, meaning that they could have taken the rate cuts over the last 3 months down to a full 1%, a full 100 basis points. I agree with that. I've been saying that for months now. I think that the magic spot was to bring rates down between 1% and 1.5%. I think, and they've only brought them down about what I think is about halfway, about 75 basis points, about halfway to the point where I think they need to be. Now, do I think that they need to bring rates down to, bring them all, like to back down to like 2%, 2.5%? No, I think that's too much. And why do I say that? I say that because if we do end up in a recession, or if the the labor market really does bottom out, right, in say 2026 or even into 2027, well, if you bring the rates all the way down, you don't have anywhere to go at that point. Like you're basically stuck. You've got no bullets left to the chamber, so to speak. You're just, there's nothing you could do. I mean, rates are down. I mean, you're not going to take rates negative. So you've got to leave yourself some breathing room there. The other thing is, I would say that, when the Fed was doing what was called ZIRP, zero interest rate policy, when they were doing ZIRP for about a decade, that was bad. That was really, really bad. We cannot go back to ZIRP. We cannot go back to basically effectively zero interest rates. We can't do that again. Not ever again. We cannot do that. So, people hoping to see 3 or 4% mortgage rates, I don't think we're going to see that. I hope that we don't ever see that again in our lifetime. I really do, because if we do see it, that means something really horrible has happened. Something really horrible has transpired, and our economy has totally imploded or blown up. And that's why rates were basically cut back to zero. So we really do not want to see rates that low. But do we want to see rates a little bit lower? Would it be good to see rates down another 75 basis points, taking them down 150 basis points from where the Fed started back in September? Yes, I think that is the good equilibrium, if you will, of where the market should be at. So, but looking here for a second, so President Donald Trump said the Federal Reserve's latest decision to cut the benchmark interest rates could have been at least doubled. Trump called Fed Chair Jeremy Powell a stiff, who approved a rather small cut. Trump also said he plans to interview former Fed Governor Kevin Warsh, a possible contender to succeed Powell when his term ends. We're going to get to that in just a second. But let's move on here for a minute here. So now let's focus on one of the dissenters from this week's meeting for just a second. So the Fed Goolsbee said he's uncomfortable front-loading too many rate cuts. So Chicago Federal Reserve President Austin Goolsbee on Friday explained why he voted against this week's interest rate cut, telling CNBC that policymakers should have waited for more data on inflation and unemployment. Goolsbee was one of 3 Federal Open Markets Committee members to vote against the quarter percentage point reduction. I'm pretty optimistic that for 2026 rates will be able to be a fair bit lower than they are today, the central banker said during the interview. Several other Fed officials also weighed in Friday on their monetary policy stance. And hang on, bear with me for a second here, guys. I need to drink. My throat's starting to bother me here. Had to go to the Diet Coke tonight. The water's not doing the job. I need some soda to kind of soothe this out here a little bit. Yeah, hey, if Coke would like to give me, hey guys, if you'd like to give me a part, be a sponsor, would love it. probably about zero negative 1,000% chance of that. All right, so Chicago Fed President Goolsbee on Friday explained why he voted against this week's interest rate cut, telling CNBC that policymakers should have waited until they had more information before easing further. Pretty optimistic that for 2026, rates will be able to be a fair bit lower than they are today, the central banker said during a Squawk Box interview. But I've just been uncomfortable front-loading too many rate cuts and assuming that what we've seen in inflation will be transitory. There he goes with that. All right, guys, I cannot express to you my utter disdain for the word transitory. That is just the stupidest word. And there is no such thing as transitory inflation. There never has been. Sorry, I had lost it there for a minute. Goolsbee was one of 3 Federal Open Market Committee members to vote against the quarter percentage point reduction, the third consecutive easing measure. He was joined by Kansas City Fed President Jeffrey Schmid, as well as Governor Stephen Miron. While he has said in the past he sees room for rates to come down further, Goolsbee said a lack of progress on inflation argued against moving right now. Recent readings show the annual inflation rate around 2.8%, well above the Fed's 2% target. There's no way around. We've been 4.5 years above the inflation target. Now, whose fault is that? I mean, seriously, was it our fault that the Fed decided to inject? They decided that during the pandemic, the Fed decided to take their balance sheet from $4.5 trillion up to $9 trillion. Was that us that made that decision? No, I think it was them that made that decision. But that's okay. I just like that the tone would seem to insinuate that they had nothing to do with the inflation being up as high as it is. So you got to love that. And the last 6 months have shown no progress, Goolsbee said. Right before the lights went out for the government shutdown, you saw a couple of relatively disturbing readings on services inflation. I just want to make sure that if we believe that this is transitory, let's not just put all of our eggs in it. Now, if Mr. Goolsbee was being honest, okay, what Mr. Goolsbee would tell you is that, we haven't seen any progress in the last 6 months. Yeah, well, that's because you guys were busy doing this. See, you guys were busy draining all of the money out of the repo market and reducing your balance sheet. And therefore, doing quantitative tightening, not easing, quantitative tightening. Remember, reduction of the Fed's balance sheet is a form of quantitative tightening. So they continued to do quantitative tightening right up until today, when they decided to go out and buy $40 billion in short-term bills. So again, if they really cared about what they were doing, they wouldn't have been doing this all year long. They would have paused this at the beginning of the year and said, you know what, we're just going to take a time out for a little bit and see, what's going on there and how this continues to work out. But of course, he's not going to tell you that. He's going to continue to give you platitudes about the inflation and the unemployment rate. So, all right, let's take a look at this. The case for more Fed rate cuts could rest on a systematic overcount of job numbers. So in the Federal Reserve's battle between fighting inflation and unemployment, the latter side carried the day Wednesday and could also have an edge heading into 2026. At his Wednesday news conference, Chair Jeremy Powell mentioned several times that there likely has been negative job growth in recent months, a condition that would argue for easier monetary policy. Balancing support for the labor market and quieting inflation will be central to policymaking as the Fed heads into 2026. So, in the Federal Reserve's battle between fighting inflation and limiting unemployment, the latter side carried the day on Wednesday. In the immediate term, worries over the unemployment situation meant a vote, albeit divided by a 9-3 margin, to lower the central bank's key interest rate by a quarter percentage point. Down the road, there are indications that policymakers will be more inclined to cut further if the labor market stays soft. At his Wednesday news conference, Chair Jeremy Powell mentioned several times that there likely has been negative job growth in recent months, a condition that would argue for easier monetary policy. Gradual cooling in the labor market has continued, Powell said. Surveys of households and businesses both show declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, just a touch more gradually than we thought. At issue is a monthly estimate the Bureau of Labor Statistics performs of how labor market is affected by businesses closing and opening. The estimate, known as the birth-death model, takes a guess at the jobs gained by openings and lost by closings. Powell said the model has probably overstated jobs by about 60,000 per month since April, with job growth averaging just shy of 40,000 in that period. An overestimate that size would equate to payroll losses of about 20,000 per month. Now, this is why the Bureau of Labor Statistics, this is why their person at the head of it got fired. And we still don't have a replacement at the top of the Bureau of Labor Statistics. We're still waiting on that. We thought EJ Antoni was an economist. We thought EJ was going to take over, but that got ex-nayed and shot down. So we're still waiting for a new head of the Bureau of Labor Statistics. But keep in mind, we have already seen the numbers proving that there were over 2 million fake jobs during the Biden administration. I mean, the manipulation of the job market is just literally out of sight. It's just completely out of this world. There are a lot of problems with the job market. You know, the number of jobs that are on the market. How real is that? We'll see something a little bit later on that piece of it. You know, in other words, there's a lot of these ghost jobs and fake job postings. You know, there are a lot of people out there looking for jobs, and it's taking a lot longer to find jobs than people would like right now. And so again, I think this really does bring into question the overall strength of the labor market. And I would say it is more important right now to try to get the labor market going than it is to try. I truly believe, even by the Fed's own projections, their own projection models, the inflation is going to gradually come down over the next 2 years. We are going to get back down to 2% over the next 2 years. It's going to, like I said, it's going to gradually nudge its way back down. However, that's nice. But however, in the meantime, the labor market is got problems, and this is why we need to cut the rates to help the labor market. So, and again, Powell urges caution, yada yada yada. But like I said, we'll see here. Again, hopefully they can get a new head in there over at the Bureau of Labor Statistics, and we can start to, hopefully, again, I keep saying the word hopefully. Start to get economic numbers that we can trust again, start to get job labor market numbers that we can trust again, because it's been a long time since we were able to trust those numbers. Now, this was interesting. So Trump says he heard that the Biden Fed appointments were signed by AutoPen, tells aides to investigate. So President Donald Trump said he just heard that all 4 appointments to the Federal Reserve by former President Joe Biden were signed by AutoPen. Trump, who provided no evidence for the claims, suggested that the AutoPen signed appointees could include Fed Chairman Jeremy Powell. 3 other current members of the Fed's Board of Governors, Vice Chair Philip Jefferson, Governor Michael Barr, and Governor Lisa Cook are Biden appointees. So again, very interesting. I don't know if this goes anywhere, but it is interesting to point out that, obviously the AutoPen has been a major scandal, and this could just add to that. So we'll see, again, we'll see. I just wanted to point it out. We'll see what happens with there. So now Let's spend 2 minutes here and let's just talk about what's happening with the potential for the Fed, the next Fed chair. So Trump has basically said he's going to start the final Fed chair interviews, beginning with Kevin Warsh. So President Donald Trump will begin the final interviews of candidates for the Federal Reserve chair this week, putting back on track the formal selection process that began this summer. We're going to be looking at a couple different people, but I have a pretty good idea of who I want, Trump said Tuesday night aboard Air Force One. The interviews by Trump and Treasury Secretary Scott Bessent will begin with former Fed Governor Kevin Warsh on Wednesday, and also include Kevin Hassett, the director of the National Economic Council. At some point, according to two sources, it restarts the process that was derailed a bit last week when interviews and candidates were abruptly canceled. Trump said recently he knew he was going to pick to succeed current chair Jeremy Powell, and prediction markets overwhelmingly believe it would be Hassett. But his possible selection received some pushback from the markets recently, especially among fixed income investors concerned Hassett would only do Trump's bidding and keep rates too low, even if inflation snaps back. So it's unclear if these interviews are a sign Trump has changed his mind or just the final stage of the formal process. So yes, so a couple other thoughts on this. So Trump says Warsh and Hassett are leading contenders for the Fed chair pick. Trump said the two Kevins are at the top of his list for Fed chair nomination. Now, Kevin Hassett, the Trump Fed chair frontrunner Kevin Hassett hints at a comprehensive Federal Reserve overhaul. Kevin Hassett signals he would evaluate research divisions and replace staff if selected. Now, that is music to my ears. This is what I have been wanting. I've wanted somebody who will go in there and really make a shakeup at the Fed. Get these guys out of their groupthink. Start banging some of those 20,000 PhDs they got over there over the head, and basically say, hey, guys, get your head out of your know what, and let's actually start making, hopefully, some smart decisions, and hopefully find a way to reverse it so that we're not losing $300 billion. That would be a start, right? So Kevin Hassett is signaling he's ready to shake up the Federal Reserve. In an interview with Fox Business's Larry Kudlow on Tuesday, the National Economic Council director and Fed chair frontrunner openly hinted he would overhaul key parts of the Federal Reserve and scrutinize everything from the Fed's research divisions to its regional presidents. The point is the Fed should be focused on monetary policy and to try to stay out of politics. Yes, I agree 100%. And think about how many times in the last couple of years, or even just this year, you've seen Fed people from regional presidents all the way up to people at the top go on and on and on about tariffs, and even falsely asserting that tariffs could be inflationary, and to make it your main talking point every time you give an economic speech is to do the opposite of what Alan Greenspan advised us to do. I think that the Fed needs to go back to being a nonpartisan organization that focuses on bank regulation and on monetary policy and tries to stay out of politics, he emphasized. Yes, I couldn't agree more with that. Could not agree more with that. I think those are great comments. My concern with Hassett here has always been that, this guy doesn't, to look at this guy, there are adjectives you could use to describe him, okay? Butt kicker, probably not one of those adjectives. He doesn't strike me as a guy that's going to strike fear into the heart of other human beings. Little bit on the nerdy side, I have to say. Yeah, is this guy going to go in there? Is he really going to strike fear into the heart of the economists at the Fed? Maybe not. That's always been my question: is how serious is this guy? And even if he is serious, do we really believe that he can do it? Is he really going to sell Trump and Bessent on the fact that he's going to go in there and just start, kicking butt and taking names? I don't know. I just don't know. But let's look at something else here for a second here. So Hassett likely next Fed chair, but most think Trump should nominate someone else, according to a CNBC Fed survey shows. Fed survey. While markets expect Kevin Hassett to be named the next Federal Reserve chair, he is pointedly not the choice of respondents to the CNBC Fed survey. The December survey shows 84% believe President Donald Trump will tap Hassett, director of the National Economic Council, to head the central bank, but only 11% think that's what the president should do. Fed Governor Christopher Waller is the favored pick of 47% of respondents, followed by Kevin Warsh at 23%, but only 5% of respondents think Trump will pick either of the two. Again, will be, should be. Hassett is at 84%. Waller's only 5%, but 47% think he should be the guy. Warsh, 5%, think he will be. 23% think he should be. So, again, interesting opinions here. Concern about Hassett's looks to be centered on his commitment to the Fed's dual mandate and independence. 76% of respondents think the next Fed chair will be more dovish than current Fed chair Jeremy Powell. That is, quicker to cut rates if labor markets weaken and slower to raise them in the face of above target inflation. A 51% majority believe the next Fed chair is likely to fulfill the president's desires for lower rates, compared to 41% who believe he will act independently. When it comes to this week's meeting, respondents expect a hawkish cut. We already talked about that. While 87% believe the Fed will reduce rates, just 45% it thinks it should. Two dissents are expected, and just 35% forecast a cut in January. It talks about like economic outlook. So again, I just thought that this chart here, and I can blow this up a little bit for everybody. I just thought this was interesting. I thought, Hassett, 84% think that he's going to be the guy, but only 11% think that he should be. Whereas Waller and Warsh, much higher percentage of individuals thought that they should be the guy, but only 5% thought that either one of them would get picked. And again, I will say, Waller and Warsh, there are a couple of these guys that, their resume, fits the bill. Like, their resume would suggest that, they would be good picks. I'm uneasy with both those guys for various reasons. Partly because of their politics, partly because of their history, partly because of, just where they're coming from. And again, like I said, of the main people that have been the front runner for the Fed job, I have not really been tickled to death with any of them. I wouldn't choose. I personally don't think I would choose any of these guys. I think I would go with yet another option. Again, I think you need to think outside the box here this time around. I think you need to pick somebody who is really going to go in there and is going to shake things up, and is basically going to say that, hey, we're not playing. Again, Kevin Hassett, in that interview, he just said all the right things. He just said all the things you want to hear. We're going to go in and shake the Fed up. We're going to be non-political. We're going to do this. We're going to do that. That's music to my ears. That's what I was hoping to hear. I just don't know that I believe it from him. I'm coming from him. I don't know that I believe it. I don't know that he is truly going to deliver on those promises that he's making. So that's I don't know. I'll leave it at that. That's just kind of my thought on that. Now, let's jump into something else here for a second here. So I kind of beat the Fed conversation to death tonight. So, so let's jump to another thing here, shall we? So Scott Bessent is to propose a major overhaul of a regulatory body created from the financial crisis. So Treasury Secretary Scott Bessent is proposing a major change in how the government approaches financial regulation and stability, CNBC has learned. Whereas the agency focus has been on tightening regulations and oversight of the institutions it oversees, the new plan will switch that and push for looser regulation and a freer approach. So Treasury Secretary Scott Bessent on Thursday proposed a major change in how the government approaches financial regulation and stability. In a letter released Tuesday afternoon, Bessent will recommend altering the approach of the Financial Stability Oversight Council, also known as the FSOC. Whereas the agency focus has been tightening regulations and oversight of the institutions it oversees, the new plan will switch that and push for looser regulation and a freer approach. The Council will work with and support member agencies in considering whether aspects of the U.S. financial regulatory framework impose undue burdens and negatively impact economic growth, thereby undermining financial stability, the letter states. Bessent further noted that the impact of additional regulations is assessed in isolation, not in how it impacts the economy broadly. The cumulative burdens of regulatory and supervisory regimes and the interactions among individual rules are rarely considered. He said, yeah, he's absolutely right. FSOC was formed in the wake of the financial crisis of 2008 to monitor and address the kind of systemic risk that led to the collapse of major Wall Street institutions and sent the economy into its worst slump since the Great Depression. The council was created in 2010 as an outgrowth of efforts to prevent such a crisis from happening again. As Treasury Secretary Scott Bessent chairs the council, the proposal coincides with the FSOC meeting slated for Thursday, at which he delivered a letter updating where it stands on its work. The plan also lines up with the Trump administration's focus on deregulation, but represents a switch from the council's longstanding tilt towards stronger regulation. Along with the proposal, Bessent is forming a working group whose mission will be to explore opportunities for artificial intelligence to promote the resilience of the financial system while also monitoring for potential risks to financial stability that might be posed by the adoption of AI. Bessent will contend that lowering regulatory barriers and oversight will strengthen the financial system and boost economic growth. So, but again, very interesting update. The FSOC heading for some big changes, which I think are positive. I actually think these are positive. And again, he's not getting rid of the FSOC. He's basically just changing the tone, if you will. He's basically saying, hey, look, we're not going to look for tighter regulation. We're going to look to start to loosen things up a little bit. And again, hopefully to lead to, getting banks to wait for it, hopefully lend more money and get more things going out there. Okay, this was a big happening here this week. So Jamie Dimon got very upset at Trump allies. Hang on one second. Okay, there we go. Yep, sorry. Jamie Dimon got very upset at Trump allies over JP Morgan's subpoena rolled in the Jack Smith probe. So CEO says bank only turns over records when legally compelled by a court subpoena. Well, don't worry, Jamie. I'm sure that's on its way. But JP Morgan Chase CEO Jamie Dimon is hitting back at critics who allege the bank willingly cooperated with the chief counsel's probe into President Donald Trump's allies, insisting those claims are baseless and blasting those pushing them. An exclusive interview with Fox Business's Maria Bartiromo that aired Monday, Dimon said people have to grow up and stop making up things, arguing the bank only turns over records when legally compelled by a court subpoena, not for political reasons. People have to grow up here, okay, and stop making up things and stuff like that. I can't talk about an individual account. We do not debank people's religious or political affiliations. Dimon asserted, we debank people who are Democrats. We debank people who are Republicans. We're debanking different religious folks. Never was for that reason. Yeah. Jamie, I think this is a mistake on Jamie's part. I think Jamie should lean into this a little bit, actually, and I think that Jamie should basically take a different approach here. I think, and I want to read something else to you guys here for a second. Where is the debanking news? Okay. All right. So the Office of the Controller of the Currency, the OCC, said it found early evidence that 9 of the biggest banks in the U.S. had improperly refused to do business with people from highly politically charged industries like fossil fuels and firearms, the Wall Street Journal reported. It is unfortunate that the nation's largest banks thought these harmful debanking policies were an appropriate use of their government-granted charter and market power. The report quoted Controller of the Currency Jonathan Gould in a statement. The 9 banks were JP Morgan Chase, Bank of America, Citigroup, Wells Fargo, U.S. Bancorp, Capital One Financial, PNC Financial Services Group, and Canada's TD Bank and Bank of Montreal, according to a Bloomberg News report. So again, I wanted to point that out because this is basically what Jamie was firing back on. He was firing back on that OCC report that came out that basically said, yeah, we investigated it, we looked at it, and we found that they were, in fact, debanking people based on political beliefs and political and religious beliefs, which is, again, is a major no-no. And again, this is not shocking. And anybody with half a brain knows that they were doing this. Okay, anybody knows they did this stuff. Okay, we all saw it. People. Again, stop pretending like it didn't happen. It absolutely happened. They absolutely did it. There were people. Everybody knows who they are. There were Republicans out there that got debanked left and right by these banks. And that's why I'm saying that Jamie should take a different tact here. I think he should lean into this. I think Jamie should basically say, hey, you know what? Maybe we did make some mistakes. Maybe we did do some things wrong. Maybe we did overreact under certain pressure from the last administration to do certain things. And maybe that was wrong. And maybe we should make sure that this doesn't happen again. That would be a better tone. I think that would be, because again, I think Jamie is barking up the wrong tree. I think if he's just going to continue to sit here and basically say, well, we're not turning over any records and we didn't do any of this and this is all a lie and people need to stop making things up and people need to grow, using the defense of people need to grow up when it's blatantly obvious that you did something, like, yeah, that's not going to work. And I don't think that's going to work in a court of law either. I don't think you could get up there and say the people need to grow up defense. I don't think that's going to work out too well for him in court. So, and again, I think that when the penalties for this come, and they are going to come, when they come, they're going to be so much worse because of what he just did right here. Basically trying to shut it down, trying to not cooperate, trying to say that this is all make-believe and people need to grow up and everything like that. That's not going to help when the penalties come down. Like I said, I think that he should lean into this. I think he should take a better tone. And I think he should say, hey, let the investigation take its course. And if it finds out that we did do some stuff wrong, which I would say something to the effect of like, hey, we don't think we did anything wrong, but if the investigation should find out that we did, then that's okay. We'll work with them and we will, make sure that this doesn't happen again. I think that would be the better approach for Jamie in this situation, but he decided to go 180 degrees in the other direction. So let the chips fall where they may now. But again, these guys are guilty of sin here. They're not going to be. I mean, look, they can push back all they want. They could try to stonewall. They could try to do this, but at the end of the day, they're going to get busted for this. They're going to get nailed big time. And we'll see what happens. I'll keep everybody updated. So, all right. This article is hugely important. But before I go into that, I want to switch gears because this is a time of the show where usually I like to spend a few minutes. I just like to talk about the episodes that I put out this week. I also like to give you guys the economic indicators for this week, and I also like to give everybody some just general banking news. So, first up, let's do the economic indicators, shall we? So what do we have coming out this week? So on Monday, December 15th, we have the New York Empire Manufacturing Index. On Tuesday, December 16th, we get the ADP Employment Change Weekly, the average hourly earnings, non-farm payrolls, participation rate, unemployment rate, manufacturing PMI, services PMI. On Wednesday, December 17th, we get the core retail sales, the retail sales for October, business inventories for September, 20-year Treasury bond auction is at 1 o'clock. On Thursday, December 18th, we get continuing jobless claims, CPI, initial jobless claims, Philadelphia Fed Manufacturing Index, and then finally on Friday, December 19th, we get the PCE Price Index, existing home sales, Michigan consumer sentiment, and the U.S. Baker Hughes total rate count. So, wow, it is fantastic. We got a lot of economic data now coming fast and furious. A lot of inflation numbers, some labor, some employment numbers. So a lot of really good stuff coming out this week. So we got a lot of really good economic data coming out this week. So, okay, what were the 5 episodes that I put out this week? So hang on a second. All right, so first up on Monday, the episode I did was FASB. The FASB makes update to help the CECL double count issue. Now, back in August, I had done an episode on M&A, the M&A issue related to what's called the CECL double count. And the Financial Accounting Standards Board has issued an update that changes the accounting for loans acquired in an M&A transaction. So this long-awaited fix matters to any bank entering an M&A transaction. This change does not take effect until December 15th of 2026, but early adoption is permitted. So again, I think that was a great change by FASB, and it really should help bank M&A transactions. So then on Tuesday, I went to how are banks budgeting for 2026. So during budgeting season, the conversation usually goes to cost containment and incremental improvements. However, the most successful community banks invest strategically in infrastructure that creates measurable ROI and sustainable growth. The trick is to identify investments that will lead to operational efficiency and a positive customer experience. Community banks need to think about going from maintenance to transformation, how data will be used for decision making, making your business case, considering scalability, and then focus on planning with purpose. So again, I thought it was a really good episode to really hopefully encourage different bankers out there to think about what are you doing? This is the time of year where you're getting into strategic planning and budgeting, and what are you really doing in that process? How are you thinking about it? And how are you going about potential changes that might come in 2026? So, okay, then on Wednesday, I put out who are the best community banks for 2025. So this episode looked at 5 community banks from around the country that were honored by Independent Banker Magazine as the best community banks to work for in 2025. The honorees include Bank of Boozman, which is located in Montana, Texas Traditions Bank in Texas, People's Bank and Trust in Georgia, Olympia Federal Savings in Washington, and People's Bank of Texas. Each bank offered tips on employee development, culture building, staff retention, communication, and the little things. The article ends with a data dive on various aspects of what employees want and how to keep them happy. So again, congratulations to all the banks that were named in there. I thought it was a great article and really pointed out some really good banks around the country. So then on Thursday, I did an update. There was basically fraud alleged in the failure of First National Bank of Lindsay. Now, the First National Bank of Lindsay was a small bank. It was about 107 million asset bank. It was located in Oklahoma. And that bank closed in October of 2024. It was the second bank to fail in 2024. And in 2024, the OCC stated, after identifying false and deceptive bank records and other information suggesting fraud and revealed depletion of the bank's capital, the lender was in an unsafe or unsound condition to transact business. Now, today, not today, but in the last week, now the former CEO, Danny Siebel, has been indicted by a federal grand jury on charges of bank fraud. So again, just wanted to bring this update to the story based on the new information that just came out about the ex-CEO being indicted on bank fraud charges. Yeah, he pretty wild. He was basically just making up loans, making loans to his friends that they didn't pay back. So pretty crazy story there. So if you have an interest, it's I guess it's a my version of like a true crime story. if you want to go check that out. I love true crime, by the way. It's one of my favorite things. Friday, today, the episode I put out today was community banks really need to get on the digital wallet train. By 2027, half of all e-commerce transactions will go through digital wallets. Community banks need to get their own cards into a customer's digital wallet before someone else does. It is critical to get your card in the top position in a customer's digital wallet. Banks can offer several incentives for this, which include cash back, promotions, top of wallet rewards, and referral bonuses. It is also critical to understand who is leading the mobile wallet pack and what the regulatory landscape looks like. So that episode looked at an article and a blog post, but I really think that the digital wallets issue is a major issue out there for banks. It really is it's where we're heading, especially with the crypto legislation and all the talk about financial assets being, digitized through financial, on blockchains and tokenization and all this kind of stuff. So the digital wallet is just very, very important, I think, to the future strategy of community banks, and basically, I think offering your own digital wallet, but keeping your debit card at the top of that wallet. So in other words, meaning that the customer is using your debit card. That is absolutely critical to community banks out there. So again, thought that was a really good episode. So check that out if you get a chance. So those were the 5 episodes I put out this week. The other thing I wanted to mention was I have been putting out what I've been calling strategy room bonus episodes more recently, and some of the more recent episodes that I put out were subprime auto industry crisis, private credit market update, Epstein problems persist for banks, update on tariffs, update on mortgages and housing, retail sales and Black Friday update, Fed and repo market update. That was a great one. Examining AI from different angles. I thought that was a great one. You check that out. And then I did some thoughts on Robinhood. Now, why I'm putting out these bonus episodes is that I'm hoping to give people a taste. Like, in other words, if maybe you missed last week's episode, maybe you don't have the time to sit there and listen to me for 2 hours, whatever. I understand. I've got a lot of podcasts and stuff that I'd like to listen to for 2-3 hours. I just don't have the time always to do that. So I'm hoping to put out these little snippets so that people can get, some of the main stories that I'm covering in that 2-hour podcast, and can also, so if you miss out something, hopefully it's a lot easier just to watch maybe a 5 or 10-minute segment on a particular topic that hopefully interests you. And so again, I'm putting those out. People seem to like them, so I'm going to continue to do that. I'm going to continue to kind of take these snippets from the show and just turn them into really short little, bonus episodes, if you will. So hopefully people will just keep an eye out for that. So, okay, let's get into some bank news here, shall we? All right, I'm going to start out with some economic indicators and some other things here with you guys. So Fed announces reappointment of Reserve Bank leaders. We talked about that a few minutes ago. Farm Credit reports on funding conditions. So the Farm Credit Administration received a quarterly report on economic conditions affecting agriculture and an update on the financial condition and performance of the farm credit system as of September 30th. Okay, fair enough. We'll see what happens with that. Wholesale inventories increased in September. Mortgage rates were up in the latest weekly report. The rate for the 30-year fixed rate mortgage averaged 6.22% this week, up from 6.19% last week. So just a tad bit increase there. CDFI Funds cancels their webinar. So the CDFI Fund announced that its December 11th quarterly annual certification and data collection report webinar has been canceled and will be rescheduled for early 2026. Consumer sentiment was up in early December. Consumer credit is up in October. Personal income spending rises in September. New York Fed survey inflation expectations remain steady. The Federal Reserve Bank of New York's November survey of consumer expectations showed that households' inflation expectations remain unchanged at the short, medium, and long-term horizons. Labor market expectations improved slightly, but respondents' perceptions and expectations about their current and future financial situation became more negative. Trump administration announces a $12 billion farm aid package. We're going to talk about that in just a minute. Bessent to refocus the FSOC. We just talked about that. ICBA tells Senate panel that the IORB is vital to the financial system. Now, ahead of a hearing on the Federal Reserve's policy of paying interest on reserve balances, the IORB, to financial institutions that maintain balances at the Fed, the ICBA told senators that the IORB is important to community banks and the financial system. Now, I want to read you a couple comments. This is actually a very important thing. The reserves that the Federal Reserve has. So basically the Federal Reserve is paying interest rates on those reserves. They're basically paying interest rates to the banks to keep those reserves in place. Okay, so it seems very innocent on the surface, right? Okay. Well, so what did they say here? ICBA said it hopes the hearings will dispel misunderstandings concerning IORB, including the mistaken argument that IORB costs taxpayers and that its elimination would save taxpayers dollars. Now, let's talk about that for a second, because that's a very important thing. It is costing the taxpayers dollars today, right now, because the Federal Reserve has lost over $300 billion and continues to lose money every month. One of the reasons why they're losing that money is because they are paying interest on those bank reserves. So it is costing the taxpayers money right now. So that is not a misunderstanding, so to speak, as per what this says here. Now, does that mean that these reserves will always cost the taxpayer money? No, not necessarily. Just in the situation that the Fed is in right now, it's costing them money. But I need people to understand that the Fed paying interest on these reserves was not always so. This was something that really came about after the financial crisis, when basically the Fed was looking for a way to settle the market down, to get banks back into a good spot, to kind of, pump the banks back up, so to speak. The Fed came up with this idea to basically say, hey, we're going to give you all this money, but we don't want you to lend it out. So what we're going to do is we're going to start paying you interest on those reserves. And what they're going to do is we're going to give you this money, but we're not going to give it to you directly. We're going to put it in an account here at the Fed. And what you're going to be able to do, Mr. Bank, is basically you're going to be able to say, hey, I've got all this money now back on my balance sheet. My balance sheet looks great now, and I'm good. So then the banks all ran on to CNBC and all said, hey, look at our balance sheet. Our balance sheet's fantastic. We stabilized everything. Everything's going good. So that was nice. And then the bank stock prices start to go back up. The market begins to stabilize a little bit. But then a funny thing happened, okay? About a year or two into the recovery, people started complaining because they're basically going, well, I don't understand. The banks aren't lending any money. I'm going into the bank and the bank won't lend me any money. So if you remember back then in like 2010, 2011, 2012, we basically had no growth and the banks weren't lending money. And what people didn't understand was that banks were being told not to lend the money. They were basically like, no, we're going to pay. And this is why they were getting paid the interest on the reserves. And this is also why we didn't have a major spike up in inflation. Because remember, look at the different scenarios. During the financial crisis, the Fed technically, gave the banks money, but it was in money at the Federal Reserve account. It was not, the money did not go into the hands of consumers. And the Fed actually told the banks not to lend the money out, and they paid them the interest reserves. Now, what happened over time is that the banks got very used to getting that interest reserve money, and they didn't want to let it go. So they like getting their reserve money right now. They don't want that to necessarily end. That's why ICBA is advocating to say, hey, we need to keep it. I would advocate right now that money should really, that those reserves really should get knocked down to next to nothing at the moment. And the bank should be focused on going out and lending money and getting it out there on the street, because they'll make more money by lending it. But compare the crisis, right? Financial crisis versus the pandemic. What happened during the pandemic? And during the pandemic, they printed the money, and then what did they do? They gave it directly to the consumers. They gave it directly to the businesses. It was a direct injection right into the arm of the economy. Bang. And when you inject all that money into the economy, what happens? You get massive inflation. And that is exactly what happened. But back in the aftermath of the financial crisis in 07 and 08, they gave the money to the banks technically, because it didn't actually leave the Fed. It was on the Fed, but the Fed created an account for those banks, and then the banks got to say, oh, look at all this money that we got, and we put it on our balance sheet. So hopefully that gives people a little bit more understanding into how all of that unfolded. So this issue of the Federal Reserve paying the interest on the reserve balances, this is an argument that's going to continue for a while, but I wanted to talk about that for a minute. So, okay. OCC releases findings on large bank debanking activities. We talked about that. Senators request hearing on digital asset market structure. So the Senate Banking Committee members John Kennedy and Jack Reed asked the committee's leaders to promptly schedule a hearing on digital asset market structure policy before hosting a legislative markup. So we'll see what comes about that. OCC confirms permissible bank activities related to principal crypto asset transactions. So the OCC confirmed permissible bank activities related to riskless principal transactions in crypto assets. So what did it say? Well, it said a national bank may engage in riskless principal crypto asset transactions as part of the business of banking. Such transactions involve a bank acting as principal in a crypto asset transaction with one customer while entering into an offsetting transaction with another customer. In these transactions, the bank does not hold the crypto assets in inventory, serving as an intermediary in a capacity equivalent to a broker acting as an agent. So what does that do? That opens the door for a bank to be a custodian, which is what I've been saying for months now, that banks should really look at being the custodial, playing the custodial role for crypto assets until they get a little bit more comfortable with the whole thing, with stable coins, with the cryptocurrency, with how digital assets work. Once the banks start to get more comfortable with that, then they can move into the space. But to start with, they should just start with the custodial aspect. Again, the digital wallet, going through the digital wallet. Monday is the deadline on 1071 grassroots outreach. So ICBA continues urging community bankers to weigh in with the Consumer Financial Protection Bureau on its Section 1071 proposed rule ahead of Monday's deadline. So yes, absolutely. ICBA urges Fed to withdraw its debit interchange proposal. So ICBA and other groups urge the Federal Reserve to withdraw its 2023 debit interchange proposal until there is legal certainty in several court cases. So we will continue to monitor that. Congress continues to back the CDFI fund report. So members of Congress are strongly supporting community development financial institutions in current budget decisions. So we'll see what happens there. OCC's Gould digital asset entities should have pathway to charters. Controller of the currency, Jonathan Gould, said entities that engage in activities involving digital assets and other novel technologies should have a pathway to become federally supervised banks if they meet OCC chartering requirements. So here's the thing. Yes, I agree with that on a whole. Yeah, they should. However, there's a huge however. I do not like the ILC banking charter. I've talked about that. I've done episodes on it. If you want to go check that out, go look it up if you want a little bit more understanding about that charter and what's that all about. I do not think they should use the ILC charter. That should be a non-starter. Forget that. If they want to get a regular banking charter, they should be able to get a regular banking charter. I mean, they should be subject to all the regulation that again, level playing field. They should be subject to all the regulation that every other bank in the country has to deal with, just like that. So again, and do I think they should be prevented? No, absolutely not. Just make it level. Just make it a level playing field. ISAC banks report passport card fraud. So fraud perpetrators are using counterfeit passport cards, not the physical card, but they actually have a passport card that looks like a driver's license. So that's what they're talking about here, using the counterfeit passport cards to attempt to withdraw cash at retail banking locations. So it's kind of interesting. OCC and FDIC withdraw leverage lending guidance. So the OCC and the FDIC announced they are rescinding their March 2013 guidance on leveraged lending and the November 14th frequently asked questions on implementing the guidance. So interesting there. USDA expands crop insurance access. So the Agricultural Department announced updates to federal crop insurance to reduce red tape for farmers, modernize policies, and expand access to risk protection. And then finally, new op-ed. Deposit insurance reform is critical for Main Street. So bipartisan legislation supported by the administration is an important starting point for meaningful reforms to the nation's deposit insurance. So yeah, I've been covering this the last few weeks. We do need some changes to the deposit insurance. I'm not sure about all the changes they're proposing, but again, we'll keep an eye on that, and I will let everybody know what's going on with that one. So, okay. Hang on for just a second. The nose is running there. Okay. I wanted to read everything here. I've done a lot of coverage on the private credit market, so I wanted to just read this. This was a little blog post from Naomi Snyder, the editor-in-chief over at Bank Director, and this is called A Risky Buildup. So it's tempting for a bank to lend the vast expanse for a bank to lend to the vast expanse of private credit, a variety of non-banks that can include mortgage warehouse intermediaries or even private equity funds. Those loans can help diversify a bank's assets. Banks also can limit their exposure to such loans by making them a small percentage of the portfolio. In September, investors began asking questions about such lending following bankruptcy filings for subprime auto lender Tricolor Holdings and the auto parts company First Brands Group, which are likely to lead to significant losses for the banks that lent to them. Yes, as I have reported, done a number of videos on that. Go check them out. Moody's reported that through the second quarter, the U.S. banks lending to NDFIs, which is non-depository financial institutions, had increased more than 300% since 2015. S&P Global Market Intelligence estimates U.S. bank loans to NDFIs have grown rapidly in recent quarters, especially at large U.S. banks, by 9% in the second quarter and 5.9% in the third quarter, reaching close to $1.5 trillion. This building of significant risk in the system may impact smaller banks that don't engage in this type of lending. During the great financial crisis in 07-08, it became all too clear that risky lending inside and outside the banking system could bring down collateral valuations for everyone. In fact, banks in the Southeast failed after seeing good, well-collateralized borrowers walk away from their loans because their mortgages were higher than the value of their underlying assets. In those years, that collateral was houses and land for new subdivisions. Bill Harrell, Executive Vice President and Managing Director for Bank Director, was an investment banker during that financial crisis, so he's well attuned to cycles that tend to repeat themselves. The more distance lenders put between themselves and the borrower, the worse the consequences. Everyone has the motivation to make the loan. Fewer have the motivation to collect it, he says. When credit problems begin to surface for NDFIs, they don't have the funding stability that banks enjoy and would need to liquidate assets quickly, in some cases overnight. That could affect collateral values across the financial system. When the worm turns, it hurts all lenders due to the impact on collateral values, he says. Harrell isn't saying what's going to happen, and indeed, he hopes it won't. But it's important for banks to be prepared for the worst. And I have echoed basically the exact same message. Like I said, I agreed with Jamie Dimon's initial comments on cockroaches. Hey, where there's one cockroach, there's usually many more. And I think there will be more failures out there. I'm keeping a keen eye on that subprime auto market in particular, which is kind of a subsector of the private credit market. But there's no doubt, that private credit market has grown to over $1.8 trillion. It's a significant market out there. If even just a portion of that $1.8 trillion market blows up, that's going to cause a lot of problems for a lot of banks, particularly a lot of bigger banks out there in the country. And those problems at the bigger banks will trickle down to the smaller banks. So again, I love the comments there at the end. It's not about saying this is going to happen, but we hope it won't. But it's important for banks to be prepared for the worst. So take a look at your portfolio, see what you're doing. I would suggest maybe cool it on the private lending, all the lending to the NDFIs and the hedge funds. I would maybe cool it on that for a little while until you see how things kind of shake out. But like I said, just wanted to read that to you guys. Thought that was pretty good. So, all right. Let's get back to the articles here. Guys, I will say an hour and a half in, I'm struggling here a little bit. You probably could tell. I don't know how much longer I'm going to be able to go here, but I want to get a couple more things in here. I really wanted to talk about this. So if I can look something up for just a second. I wanted to see, when did I do that? Was before Bank Week. Okay. Two weeks ago, I did an episode called Our Food System is in Serious Trouble. One Farmer Has a Plan. And this episode was about America's farm system is in trouble. Parts of it are collapsing in real time. And I thought that this was a extremely important episode. I don't talk a whole lot about farming and farm lending and all that on here, but our parts of our food system are in dire straits. And I think that the administration finally recognized that, and they're doing a couple of things here. So Trump orders task force. So first of all, they formed a task force, and now Trump orders the task force to protect food supply chain competition and security. So the security task forces would work toward addressing risks from anti-competitive behavior and price fixing. So President Donald Trump signed an executive order on December 6th establishing security task forces within the Justice Department and Federal Trade Commission to protect competition across the U.S. food supply chain. The order, titled Addressing Security Risks from Price Fixing and Anti-Competitive Behavior in the Food Supply Chain, states that anti-competitive behavior in the food industry, particularly by foreign-controlled corporations, poses a threat to the stability and affordability of the U.S. food supply chain. It states that some companies in the U.S. food supply chains have even settled civil lawsuits accusing them of price fixing for tens of millions of dollars. Food supply sectors, including meat processing, seed, fertilizer, and equipment, have similar vulnerabilities to price fixing and other anti-competitive practices. The president wrote in the order, "My administration will act to determine whether anti-competitive behavior, especially by foreign-controlled companies, increases the cost of living for Americans and address any associated national security threat to the food supply chains." The order directs Attorney General Pam Bondi and FTC Chairman Andrew Ferguson to establish food supply chain security task forces within their respective agencies. These task forces will take all necessary and appropriate actions to investigate food-related industries within their established areas of expertise and determine whether anti-competitive behavior exists in food supply chains in the United States and whether control from food-related industries by foreign entities is raising food prices in the U.S. The order directs Bondi and Ferguson to bring enforcement actions and propose new regulatory approaches if their respective task forces investigations uncover any anti-competitive behavior. So I think this is fantastic. This is a great response here. And then furthermore, Trump announces $12 billion farm aid program. So the aid package is meant to help farmers affected by tariffs and other factors. So President Donald Trump on December 8th unveiled a $12 billion economic assistance package for farmers. The Trump administration has been embroiled in a trade war with China, during which the nations have exchanged tariffs on each other's exports. Some U.S. farmers have struggled to sell their crops as Beijing pulled back purchases of products from such as U.S. soybeans this year and bought from other markets and nations, including Argentina. Trump made the announcement at a roundtable at the White House to discuss his economic aid package for American farmers. He was joined by Treasury Secretary Scott Bessent, Agricultural Secretary Brooke Rollins, members of Congress, and farmers from the corn, cotton, sorghum, soybean, rice, cattle, wheat, and potato industries. During the ceremony, Trump said his administration was taking a very vital action to protect and defend America's farmers and reduce prices for the American consumer. So again, love these actions. Love these actions. Again, this is really critical. In that episode that I did, the gentleman that article was about, it was a farmer named Steve Jarvis. And, Steve basically said that, Steve has kind of been there, done all that in the farming business. And, and he basically said that, hey, this should be a national security matter. This should be a major matter that basically the military should step in and get involved with protecting our food supply, because it's a matter of national security. It's a matter of survival at this point. And I don't disagree. I did not disagree with his sentiment, the sentiment of what he was saying. Like this should be on front page news. This should be all over the media. We should be talking about like what is going on with our food system and our food supply. And we really need to really put a spotlight on this. But again, the Trump administration is obviously a lot of the farmers raising their hands and saying, hey, we got major problems over here. They're starting to act. They form these task force. They're going to be looking at anti-competitive behaviors. He puts out a $12 billion farm aid program. Like this is exactly the kind of stuff that I was hoping for. It was exactly the kind of reaction that I was hoping for. So far, so good. I think there's still, I think there's a lot more that needs to be done here. I think we're still a long ways away, but good stuff here. Good stuff. So wanted to report on that. So now I've got some AI articles, and I'm gonna, like I said, in the vein of trying to end here a few minutes early, I'm gonna run through some of this stuff like warp speed here at the next 5 minutes, guys. So Trump plans executive order to curb state power over AI regulation. Actually, he did it. So the president said only a single federal standard can keep the United States ahead in the global AI race, while some states push their own safeguard. Fair, okay. I don't think that's the right approach, but okay. NVIDIA wins Trump's approval to sell H20 AI chips to China, but there's a catch. I mean, they got to pay some of that revenue back to the U.S. government. I don't agree with this at all. At all. NVIDIA should not be able to sell their best chips to China. Period. End of story. I really don't care that it might hurt their sales. I really don't care that it might hurt their stock price. I don't care. I view them selling their best chips to China as almost an act of treason. That's just how I feel about it. I do not think they should be doing that. If we're serious about winning the AI race, why would we allow NVIDIA to do this? Common sense, people. Common sense. All right. AI versus human advisors. What Americans really think about retirement planning. I thought this was interesting. So about 37% of Americans already use AI for some aspect of money management, but only 10% trust it more than a human advisor. Trust remains the deal breaker, as almost 2/3 of Americans tell surveyors that AI can't understand how emotions shape financial decisions. So just some interesting information there. I'm sure there'll be a lot more on that in the coming months. For investors all in on the Magnificent Seven led market, equal weight is trending as stock call for 2026. So investors are facing a risky and highly concentrated U.S. stock market going into 2026, with the Magnificent Seven representing as much as 35 to 40% of the S&P 500 in recent trading. So Rick Ryder, Cathmere Capital CIO, says equal weight S&P 500 ETFs are good options for investors to become more diversified in domestic stocks. He also says the value investing approach needs to be prioritized, and investors who neglected it in 2025 have missed some huge opportunities. Okay, fair enough. Oracle's AI-fueled debt load has investors on edge ahead of quarterly earnings. So Oracle stock is coming off its worst month since 2001 due to Wall Street's concern about the company's debt obligations tied to artificial intelligence. Their projections are just insane. Their CapEx spending is just utterly ridiculous. So Oracle stock is getting hammered, and rightly so. AI tools could drive $263 billion in holiday sales. Walmart and Target are racing to get in. So AI could drive $263 billion in global holiday sales this year, representing 21% of all holiday orders, Salesforce predicts. Companies like Walmart and Target are overhauling their AI strategies to ensure they're meeting consumers where they're shopping. Consumers are mixed on the tech, with one shopper saying that AI made holiday shopping fun, and another that it felt like talking to a demented grandmother. Interesting. All right, this was an important thing here. Gosh, these stupid ads on these sites. Driving me nuts. Economic calendar. These are the government data reports we're still waiting on after the shutdown. So the federal government shutdown froze economic data releases, and agencies are still working to catch up. So while a handful of reports have been rescheduled, some have also been consolidated or canceled. Other new release dates are still expected for several key reports for September, October, and November. So what do we got here? December 10th. We're going to get the Q3 employment cost index. December 11th, we're going to get the September U.S. trade deficit. Also, December 11th, September wholesale inventories. We've gotten some of these. So December 16th, November U.S. employment report, October retail sales, September business inventories on December 18th, November CPI, December 23rd, third quarter gross domestic product initial estimate. October and November industrial production and capacity utilization, and October durable goods orders. So again, and then a bunch more in January and February. Here are some reports that still need to be rescheduled or have been canceled. So September housing starts, September new home sales, September, October, and November advanced report on trade deficit. October U.S. trade deficit, October business inventories, November retail sales, November durable goods orders, October PCE price index, fourth quarter GDP advanced estimate. So again, I thought this was a good article, just pointing out, like, okay, what is the stuff that's still missing? What is the stuff we're still waiting on? So yeah, good information there. Job openings climb, but hold the applause. So again, we saw employers had 7.7 million job openings in October, more than economists were expecting and higher than August total of 7.2 million. However, layoffs also increased to their highest level since 2023, while the hiring rate dropped to levels rarely seen since the Great Recession. The data isn't expected to derail an expected interest rate cut from the Fed on Wednesday, which they did. So 7.7 million job openings in October. Not too bad, but the question you have to ask yourself is, well, how many of those are real? Like, in other words, I would say it's been reported that up to half of those could be non-existent job openings. So, so again, how many jobs are really out there? So again, so I said, I like that. Job openings climb, but hold the applause. All right, refinance demand for FHA loans jumps 24% as homeowners seek the most savings they can. So total applications to refinance a home loan rose 14% last week compared with the previous week. Applications for a mortgage to purchase a home dropped 2% for the week and were 19% higher than the same week 1 year ago. Home prices go negative for the first time in over 2 years and may stay that way for a while. So home prices are down 1.4% in the last 3 months. Active listings in November were nearly 13% higher than last year, but new listings were just 1.7% higher. Mortgage rates have been hovering in a narrow range for the past 3 months. Okay, small businesses report record monthly surge in price increases as inflation pressure mounts. So net 33% of owners raised selling prices in November as inflation concerns persist among small business owners. Okay, Janney Montgomery Scott, as I said at the beginning. So Janney is a smaller-ish investment bank and wealth management firm. They decided to exit their investment banking business to focus on wealth management. So Janney Montgomery Scott selling capital markets unit to focus on wealth management, Huntington Securities and Breen Capital to acquire Janney's investment banking divisions. Wealth management represents 90% of Janney's revenue. And then we go on here to this article. Breen agrees to buy Janney's financial institution insurance verticals. So Breen Capital LLC signed a definitive agreement to acquire the financial institutions and insurance investment banking and institutional equities business units from KKR & Company owned Janney Montgomery Scott. The agreement follows a Bloomberg report from November that Breen was in advanced talks to purchase Janney's depository M&A advisory and institutions equities business units. Roughly 50 people will be joining Breen Capital from Janney's investment banking and equity research, sales, and trading businesses, according to Brad Del Muto, Janney's director of corporate communications. After the Brain deal, real estate will be the only investment banking vertical remaining at Janney. Del Mudo did not respond to a request for comment. So, yes, just wanted to report on that happening. Business tax changes in 2026 are going to bring back some old deductions. So just some things to point out here. Tax credits and deductions expected to draw attention include business property credit. Previously, the so-called bonus depreciation was only available through 2026 and was slated to be gradually phased out. Now, the bonus depreciation tax credit is permanent and allows 100% of a property acquired to be depreciated on taxes. Research and development credit, business interest tax credit, increased expenses for depreciable business assets, special depreciation for qualified production property, extension of the Paid Family and Medical Leave Act, and expansion of the employer child care credit. So again, some really good things to look at here. Definitely call your accountant. Maybe not over the holiday break here, but definitely call them come January and basically ask them about all this stuff, because I think it's some great stuff to inquire about before you start doing your taxes beginning of next year. Employers have a new top priority for benefits. Here's what's changing. So employers are now prioritize controlling benefit costs over attracting talent. Wow, that's kind of wild. Companies project median healthcare costs will rise 10% in 2026. So the job market has softened in 2025 amid a host of high-profile layoffs, inflation, and economic uncertainty, and it's shaking up how companies are approaching their benefits offerings. While recruitment was the name of the game amid the turnover tsunami before, the priority shifted to retention. A new survey found the big factor for benefits in 2026 will be controlling costs for companies and employees alike. So fascinating. These are the most in-demand, high-paying jobs for 2026. So let's take a look here. The top six-figure jobs for 2026 ranked by their year-over-year wage growth according to PayScale are development operations engineer, median annual pay of $131,000. Cybersecurity engineer, median pay of $118,000. Compliance manager, median pay of $100,000. Senior network engineer, median pay of $131,000. A plant manager or manufacturing for a median pay of $129,000. So some interesting jobs. If you want a good paying job, there you go. All you college kids out there, pay attention to that. Okay. Trump expected to sign executive order to reclassify marijuana as soon as Monday. Sources tell CNBC pot stocks surge. So President Donald Trump is expected to sign an executive order to reclassify marijuana as soon as Monday. A person familiar with the matter told CNBC cannabis stocks surged in Friday trading sessions. There's a lot I want to say about this, but I'll wait. I'll wait until maybe the next week or two. I'm sure there's going to be some more news on this in the next week or two. I got a lot to say on that one. House passes Invest Act. The House actually did something. Be still my heart. They actually did something. They did this to ease investment standards and boost capital in markets. So the House passed the Invest Act, which backers say could get private markets more capital and investors. The package of capital formation bill passed the House. Lawmakers say the measure will help more companies go public and increase capital formation for startups. So private markets could get an influx of capital and investors under legislation approved by the House on Thursday. The package of capital formation bills called the Invest Act has passed. Okay, whatever. The wide-ranging package of legislation would allow more investors access to private markets. Lawmakers say the measure will help more companies go public and increase capital formations for startups. Instead of only wealthy or income determining who can be an accredited investor, investors could become accredited by taking an exam approved by the Securities and Exchange Commission. House Financial Services Chairman French Hill said the bill was needed in part because of the decrease in the number of public companies in America. We make it easier to be a public company in America, Hill said on the floor, House floor, during debate on the bill. We make it easier if you have a great idea to crowdsource that idea to raise money from friends and family, and we make it easier if you're an individual investor to have other opportunities in which to invest. The bill also would lift the cap for how much venture capital firms can raise and how many people can invest before they are subject to stricter disclosure and compliance regulations. The bill increases the number of investors from 500 or to 500 from 250, and increases funds from 50 million from 10 million to 50. Why did they say that backwards? I don't know. It's stupid. It also would become easier for venture capital firms to invest in each other, a change lawmakers say will help more funds reach companies in places like the Midwest and the South. So again, this could be very interesting. I'm sure there will be, again, more information on this as well. And I will, like I said, I'm sure I'll have more to report on the Invest Act as we have it over the next few weeks here. Credit score average is pretty healthy, Vantage Score CEO says, but high earners are masking signs of financial distress. So the average Vantage Score credit score was 701 in October, within a scale of 300 to 850. That's steady from a month earlier and down just 1 point from October of 2024. Vantage Score CEO Silvio Tavares says that number is pretty healthy. But the prime tier of credit has been shrinking as some consumers move up to the super prime tier or down to near or subprime tiers, Vantage Score research found. So very interesting there. Uncertainty over ACA subsidies persists as enrollment deadlines loom. So Democrats and Republicans in Congress are doing absolutely nothing on how to or whether to extend enhanced subsidies for healthcare insurance brought to the Affordable Care Act marketplace. There is a December 15th deadline, i.e. Monday, to pick an insurance plan on the ACA marketplace to ensure coverage starts the beginning of 2026. Households are in limbo and unsure how to plan financially. Yes. Nothing like wait until the last minute, right? Commercial real estate deal volume drops for the first time in nearly 2 years. Commercial real estate has had a rough go after gaining momentum coming out of the pandemic. October was the first month of negative year-over-year transaction volume growth in the sector in nearly 2 years, according to monthly data provided by Moody's as a media exclusive to CNBC's Property Play. And then finally, China's trade surplus tops $1 trillion despite Trump's attempts to contain it. What does that mean? So China's trade surplus roared above $1 trillion in November for the first time ever, despite the ongoing global trade war that has resulted in a steep drop in exports to the U.S. In the first 11 months this year, China's overall exports grew 5.4% compared to the same period in 2024, while imports fell 0.6%, taking its trade surplus to a little over $1 trillion this year as of November, up 21.6% year over year. The move comes even as China's U.S. bound goods fell for an 8th straight month despite a recent trade deal between the two economies, even as overall exports surpassed market expectations in November as manufacturers loaded up shipments to other markets. China continues to rely less on selling stuff to the U.S., wrote Peter Bukvar, chief investment officer at One Point BFG Wealth Partners. China has a massive pool of domestic savings, and China will again try to encourage consumers to unleash more of it to lessen their dependency on manufacturing and exports. So again, very interesting there. So, all right. That's all the news I got for you guys this week. That's all I can muster. I did manage to get to the typical 2 hours, which is great. But okay, let's do our typical wrap up, shall we? So before I get to our story of the week, where are my banners at? Before I get to our stories of the week, I'd just like to hit a few couple of high notes here at the end. So if you are listening to the podcast on Apple Podcasts or Spotify, please be sure to leave some reviews, as that really helps the channel. I would really appreciate some reviews there. So remember, if you're listening on Apple Podcast or Spotify, please be sure to give me some reviews. That would really help me out, really help the channel out. Make sure to visit the website right there. Make sure to visit thebankernextdoor.com. A lot of great stuff on the website. If you're trying to look up old episodes or research, looking for certain topics, got everything archived, beautiful episode guide, all that kind of stuff, everything up there on the website. So definitely go check that out. Make sure to subscribe on YouTube to get the latest information via post. Like, in other words, if I'm changing the date and time for the strategy room, or if I've got, what episodes do I have coming out this week, other information like that. If you want to get all that, the latest and greatest news, definitely subscribe on YouTube, because I put a lot of that stuff out via posts during the week. Make sure to send comments, questions, or topic recommendations to info@thebankernextdoor.com. So I love to hear from you guys. I always like to hear your comments. Would love to hear topic recommendations. So if you got any of that, please send it to info@thebankernextdoor.com. Make sure you can follow me on social media. I am on Getter, X, and Truth Social. I will selfishly say that I spend the most time on X, but you can find me on these platforms. And then just a kind of a reminder here that just BND, Banker Next Door, is on YouTube, Rumble, and all major podcast platforms. We have new episodes every week, Monday through Friday, premiering at noon. Those episodes are usually shorter, usually about 10 to 20 minutes in length. I like to do shorter episodes during the week on just specific topics. And then the Strategy Room is the main show of the channel, where I like to give you guys all the latest and greatest news and economic indicators and all that stuff of the week. And then finally, don't forget BND Strategy Room coming to you usually every Saturday night, 8 o'clock on YouTube. So those are all of my reminders. Now let's get to our story of the week. So this week we're going to do gross domestic product. So GDP is the total monetary or market value of all the finished goods and services produced within a country's broader borders in a specific time period. As a broad measure of the overall domestic production, it features as a comprehensive scorecard of a given country's economic health. Though GDP is typically calculated on an annual basis, it is sometimes calculated on a quarterly basis as well. In the U.S., for example, the government releases an annualized GDP estimate for each fiscal quarter and also for the calendar year. The individual data sets included in this report are given in real terms, so the data is adjusted for price changes and is therefore net of inflation. GDP is released by the Bureau of Economic Analysis. Now, what makes up GDP? You get consumption from consumers, plus investment from business spending, plus government spending, plus net trade, meaning exports minus imports. Add those up and you get your GDP. So that is gross domestic product. So now let's go to our quote of the week. All right, our quote of the week comes to you from former President Calvin Coolidge. I love this quote. Nothing in this world can take the place of persistence. Talent will not. Nothing is more common than unsuccessful men with talent. Genius will not. Unrewarded genius is almost a proverb. Education will not. The world is full of educated derelicts. Persistence and determination alone are omnipotent. So I love that quote from Calvin Coolidge. Again, just, persistence. It's what I live by doing my, YouTube side hustle here. All right. Well, I thank you. I thank everybody again, as always, for hanging out with me for a couple hours here on this Friday night. I hope everybody has a wonderful and safe weekend out there. Continue shopping out there for the holidays. Make sure just to stay safe. If you're traveling around the holidays, just make sure to stay safe out there. And like I said, just make sure to check out. I'll have all new episodes coming out this week, Monday through Friday. Be sure to tune in for that. And with that being said, I hope everyone has a great weekend out there. Thanks for listening. Take care, and I will see everybody again next week. Thanks a lot.